IT biggies, it's Infi, TCS, Reliance, all of these are stocks that are doing very, very well today. Some of the big contributors, Asian Paints as well. And on the flip side, you just have a clutch of stocks actually. So Yes Bank, a lot of these Vedanta, etc. So perhaps, at least for Vedanta and all, perhaps some global slowdown worries impacting those stocks. But for now, it's looking good on the screen. Rahul Arora, CEO of Nirmal Bang Institutional Equities, joins in now. Hi, Rahul. Good afternoon. So close to record highs, it doesn't look like the momentum is abating. Would you still be looking at fresh stocks to buy? Would you be increasing allocation to some of your top bets, or would you just stay away for the moment?
It's getting increasingly hard to value companies on FY20, to be very honest. Even on FY21, if you see most of the companies under our coverage, they probably don't have more than a 20% upside. So unless we expand the P multiple or earnings grow faster than we expect, it's sort of reaching a zone where it's getting tricky to push stocks to institutional clients. That being said, I think, the age-old phrase that you don't fight the flows. My sense is this could probably continue till about 12,500 till the budget comes around. The last time the Modi government came to office, the budget was somewhere in the first half of July. So it's very possible that over the next 30 to 40 days, you do make an attempt over there. But my sense is probably that will be the high for the year, is my sense, because it's getting, like I said, increasingly tough to just keep expanding PE multiples to justify buy recommendations on stocks.
Speaking of buy recommendations, Rahul, traditionally you've always had a bit of a bias towards consumption in FMCG, and a lot of your top recommendations are from that side of the market. However, the mood and flavor of the day is infrastructure, capex, economy revival, etc., etc. So, are you finding any ideas on that side of the market, or do you think that is all noise and talk for the time being?
So it's a bit tricky, Surabhi, because if you look at the conventional definition of GDP, which is C plus I plus G plus X minus M, X and M being imports and exports, I think with China slowing down and the uncertainty on the global environment, that is not too much in our control. So you're left with C, I and G. And given where the fiscal deficit is, even though the noises may be in the right direction towards the sectors that you're mentioning, I don't know how much leeway the government actually has to overshoot on its spending unless it cuts back on other sectors of the economy like education, healthcare, etc., to balance the fiscal deficit. So that leaves you basically with C and I. And typically I, which is private sector investment, tends to follow government expenditure. So there is going to be a big thrust required on interest rates coming down over the next 12 to 15 months for that part of the economy to revive. But that typically happens with a lag effect. I think those are the sectors to probably buy for the 3 exit years of this government. So I don't think that it'll probably do as well in the first 2 years of this government as it probably will in the balance 3 years. And I think the pace of outperformance of these sectors that you mentioned in the exit 3 years of this term will probably surprise a lot of people, and you can be underweight at that time at your own peril. So if using that logic, I think so even if the Congress hypothetically had come to power, they had their own version of giving a stimulus through Nyay. Now you have the BJP through its PM Kisan version. So I think there's going to be a huge thrust towards consumption because that's the easiest leg of the economy to push. So I'm not too fussed about the fact that HUL gave you a 7% volume growth or the others are giving you between 5 and 7. You have to understand that Lever giving you a 7% growth on that base is actually quite a strong number. So you may optically fuss about it not being at 10%, but at 7% volume growth, would I pay a 40 times multiple for
That's
it?
what I was going to say. You will fuss about it if you're paying 40 or 50 times. Not 50 for these stocks anymore.
They have corrected, Surabhi. I think if you look at various buckets of consumption, I think if you look at, say, a Britannia or a Dabur, they're down 25-30% from their peak. Something like a Godrej Consumer is down about 50% from its 52-week high. The rest are all down between 10 and 20%. So you may argue that the 10 and 20% are the industry leaders, like the Nestle's or the Levers. But I think there has been a bit of a valuation reset. And if you do see a pro-stimulus pro-consumption stimulus government, I don't think these stocks are going to give you too much of a better entry point from where they already are, is my sense. I reserve the right to be wrong, but given the thought process that I have, I think, incrementally, I don't see too much price damage happening on the base of what's already happened.
Would you stretch this theme, Rahul, to, on the periphery to include insurance? I mean, is there headroom left over there?
It's a very good point, Sumana. I think when you say consumption, it's not just staples or discretionary or electricals or durables. Consumption includes banking, BFSI as a whole as well. We initiated on the insurance sector a couple of months back. We really like SBI Life Insurance. I think if you look at the company, it's currently trading at about, it's giving you about 18% return on embedded value, 20% return on equity, coming to you at about 2 times price to embedded value. Its claim ratios, surrender ratios are all sort of best in class. You know, we actually ran an index on persistency on the 13th, 31st, and 61st month, and it's actually at about 114% of our index, which is one of the best in the industry. So I think interestingly, Sumera, I mean, since you're discussing insurance, I mean, there are only 24 people in India that offer insurance. If you juxtapose that to the kind of competition that's there for credit in the market overall, it's the least competitive space. And if you take SBI Life, ICICI Pru, Max, and HDFC Life, they've actually gained 500 basis point market share over the bottom 19x LIC. So I think the penetration aspect is one part of it. But I think when you say consumption, you could actually go out there and buy banks, retail-oriented banks. NBFC, some of the stronger ones would be a good way to play it. And definitely insurance companies would, we have a buy on all four of them. But our preference order would be SBI Life, maybe a Max and an iPru in the middle, and probably HDFC Life in that order.
Okay. I was looking at some of your recommendations. The one that caught my eye was Sun Pharma. Because there are so many moving parts to this story right now. And of course, I mean, there were a lot of adjustments even in the fourth quarter numbers. What do you think is working, and where's this conviction coming from?
So, when we're discussing Sun Pharma, I can give you two examples that come to my mind straight away. One was Britannia and one was Jubilant FoodWorks. Both went through their issue of pain. There was nothing wrong with the managements of these companies. There was just, there were other issues surrounding it, but great businesses and the managements knew what they were doing. In the case of Sun Pharma, there's a regulatory angle to it, I understand. But if you take the way Nestle came out of its regulation issue and where it's back to today, I think the kind of work Sun Pharma is doing in their value-added products, and especially on the specialty side, its domestic business will continue to grow at about 12-13%. I think most of the commentary of the pharma players, including Sun, is that the pricing erosion has by and large bottomed out. We're taking a big call on the specialty business, particularly two drugs, which is Cequa, which is the dry eye drug, and Illumia, which is the psoriasis drug. We think that these two itself, if they go as per plan, could add about $400 to $450 million by FY21 to Sun's numbers. So we're talking about a 500 basis point expansion in return on equity and capital employed in Sun over the next 2 years, coming to you with almost a 500 basis point expansion in the margins. Industry leader, going through a tough time, but coming to you at about 15 times or just about south. I don't think this is a company that's going to vanish. I mean, if anything, if the sector revives, it's probably going to come back as an industry leader. So I think it's probably best to buy good companies when they're going through bad times. We saw that in the case of Dr. Reddy's. It gone down to about 1,700. It came back to about 2,900 before anyone knew it. So if you're underweight, there's no point catching it when it's at the upper end of the move. It's not a bad time to take a little bit of the pain because so much negativity is around it. I'll probably be a buyer into Sun Pharma.
Okay, that's an interesting take. Thank you, Rahul, very much for joining in and giving us a couple of those ideas on the market. We need to get into a very quick break right now. We'll come back on the other side. Of course, the clock is still ticking for the announcement of the Union Cabinet portfolios.
It has taken a sharp fall. In fact, it looks like it's probably going to move into the red now. It's given up all of its gain, completely flat. And even the frontline indices now holding with just a 0.5%.
Yeah, I think the markets, sorry, the markets just started to take a bit of a profit-taking move. It's just first signs of that happening because